Can you deduct your financial advisory fees? I'm Marc from Winnipeg Financial Planning. Let's dig into it. The short answer, it depends. Today we'll be going over 3 ways that most Canadians pay their financial advisors and whether or not those methods allow you to deduct your financial advisory fees on your tax return. The first method we'll be covering is fee for service. This entails paying either a flat or hourly fee to have a financial plan completed. For example, John Smith is a certified financial planner with 2 payment options. Option 1 is you can pay him an hourly fee of $250 to complete a financial plan, or option 2 is you can pay him a flat fee of $5,000 for that same financial plan. Unfortunately, in both of these scenarios, the fees paid to John Smith would not be tax deductible. This is because financial advisory fees are considered personal expenses, and because of that, you're not able to deduct them on your tax return. Financial advisory fees are only tax deductible if you receive advice when buying or selling an investment. This brings us to our second payment method. If you own mutual funds, your advisor may have received an upfront or may be receiving an ongoing commission from the mutual fund company. As mentioned, financial advisory fees are only tax deductible if they are incurred to receive advice whenever you're buying or selling an investment. So if your advisor sold you a mutual fund and received an upfront commission or is receiving an ongoing commission, you would think that would be considered advice when it comes to buying or selling an investment, but unfortunately in this case, we won't be able to deduct the financial advisory fees. To understand why we're not able to deduct these financial advisory fees, we first need to better understand the inner workings of a mutual fund. In Canada, the average mutual fund fee is about 2%. So if you have $100,000 invested in a mutual fund, chances are you're paying about $2,000 per year. And that fee is paid directly to the mutual fund company. Once it's paid to the mutual fund company, about half, or 1%, is paid directly to the advisor or the bank branch as an ongoing commission. But the devil is in the details. In this scenario, you are receiving advice from your advisor, but you're not directly paying them for that advice. So they are getting paid a 1% ongoing commission, but it's being paid to them directly by the mutual fund company, thus rendering your fees not tax deductible. Although not all is lost. Commissions paid will increase your adjusted cost base, or ACB, so that when you eventually sell that mutual fund in the future, it will either reduce your capital gain or increase your capital loss. But this is only relevant in non-registered accounts. There will be no tax savings if you own mutual funds in a tax-free savings account or an RSP. That was a whole lot of mumbo jumbo. So what does this actually mean? Let's run through a quick example. Jane purchased a $100,000 mutual fund in her non-registered account via her advisor. That mutual fund had a fee of 2%, of which 1% was being paid to her advisor by the mutual fund company as an ongoing commission. After 1 year, Jane decided it was time to sell her mutual fund, and it was now worth $110,000. Throughout that year, as mentioned, her advisor received a commission of about 1% or $1,000. Jane's adjusted cost base was originally $100,000, so this is what she had put into the mutual fund, but because her advisor received an ongoing commission of 1% or $1,000, her new adjusted cost base was now $101,000. This had the effect of reducing her capital gain to $9,000 instead of $10,000. As this was in a non-registered account, Jane would have a smaller capital gain to input on her taxes, thus saving her some money. The final method we'll be reviewing, which is the most effective to deducting financial advisory fees, is fee-based accounts. Clients using fee-based accounts will pay their advisor directly rather than through a third party like a mutual fund. Since clients are directly paying for advice on which investments to buy and sell, they're going to be able to deduct those financial advisory fees. However, they can only deduct the fees charged in their non-registered accounts. Any advisory fees charged in their TFSA or RSP, for example, will not be tax deductible. Let's run through a quick example. Chris has 3 fee-based accounts with his advisor. He has a non-registered account, a TFSA, and an RSP. And in all 3 of those accounts, his advisor charges him a fee of 1.25%. Each account will be charged at 1.25% individually, but as mentioned, Chris will only be able to deduct the fees he is charged in his non-registered account. So let's say that Chris had $400,000 invested in a non-registered account. After 1 year, he paid his advisor $5,000 via that account. So Chris would enter $5,000 as his total carrying charges when he completes his tax return. Assuming he has no interest or other expenses to claim, he would also enter $5,000 on line 22-100 of his tax return. Assuming Chris is in a 40% tax bracket, he would save $2,000 on his taxes by adding in this expense. To summarize, if you're paying your advisor either a flat or hourly fee for them to complete a financial plan, you will not be able to deduct those financial advisory fees. If your advisor receives an upfront or ongoing commission from a mutual fund company, you also won't be able to deduct those financial advisory fees. However, you might receive some tax relief if you eventually sell that mutual fund in a non-registered account. And if you have fee-based accounts, you will be able to deduct your financial advisory fees, but only in your non-registered accounts. Thanks for watching. Hope you enjoyed the video. Hit that subscribe button, it helps us out tremendously, and we'll see you next time.